Yeah, okay. Well, I appreciate you guys taking the time to meet today. Financing, something that Brad and I actually do quite a bit in the development world. So we've gotten pretty skilled at understanding different financing options, both from a residential and commercial standpoint. So the topic, obviously today is 28 legal proven ways to get the deal done in a shifted market. There was too much content to cover in a 1-hour class. There was about 167 pages of content. So I've actually parsed it down to about 16 different ways that we'll discuss today. Just to give you a little bit about my background, the reason why I ended up diving so deep into financing options over the years is because I got into real estate right before the last downturn. So I've been doing real estate for about 16 years now. And at that point in time, I just graduated from college, started a family. And so every dollar counted to me. And so what I found really quick was I could get deals under contract, but if the lender or buyer weren't really skilled on the financing side of things, I would have deals fall apart. And so, if you're only closing, if you're lucky, maybe a house a month and that one deal falls apart, then your paycheck's gone. So I figured out really quickly that it was super important for me to understand the lending process, understand lending guidelines. And my lender at the time was probably annoyed because, if I saw a deal going sideways, I would question him on guidelines and how we could structure the deal. And he made the comment, he's like, man, I feel like you know more about the lending guidelines than most lenders or underwriters, because I had to at that point. So that's kind of my background of diving deep into lending. Obviously, through the market shift, there's been lots of different products and changes since that point in time. So some of this content may not even be 100% accurate. So I just want to give you the disclaimer that I'll share this information, but I would always, make sure to have the buyer talk to their CPA or lender just to confirm this info. That's not moving. Do you need to? All right. So there's 3 different distinct players in a real estate transaction. We have the seller, the buyer, and if financing involved, the lender. So the topics or the discussion today is going to be broken into basically 3 different parts. And that's what can a seller do in a changing market? What can a buyer do in a changing market? And what can lenders do in a changing market? And I really want you guys to get the most out of this time here. I came to the office about 5:30 in the morning today to make sure that I was prepared. So I would really appreciate you guys, giving me your attention, because I've put a lot of time into prep. And so basically, there's 3 types of people that show up to these types of meetings. There's people that are prisoner. They're here because they have to be, like my brother. He had to show up because I would have asked him why he didn't show up for my class to participate. There's the vacationer. They don't know why they're here. It's just better than going to work, right? So you're here for my class because you just don't want to deal with the stress of dealing with your clients. And then there's those people that are the explorer. They're excited about being here. They want to learn, grow their business. So my goal and hope is that you guys are all the explorer today, and that we can, put the business aside for the next hour and just focus on what we can all do to grow our businesses and help each other. Because the reality of this particular shift class is a lot of it is question and answer. The way it's structured is, there's these specific challenges, and then, what can we talk amongst ourselves to come up with solutions to understand how to best serve our clients. So what can a seller do in a changing market? The first thing is seller contributions. The challenge that is essentially presented in the shift presentation is there's a seller's being transferred for work. They need to sell their home within 60 days. The home's priced at $250,000 and the seller's not getting any offers. So essentially what I would like to discuss at this point is, what are some solutions outside of simply reducing the price that the seller could consider to assist them in selling the home? We're going to get into, 2-1 buy downs, long-term buy downs, stuff like that. This is more of relating to concessions. What can a seller offer a buyer as far as a concession that may assist in a win-win transaction? So I'm going to put these questions out to you guys. Things that you've seen, Becca.
One that helps first-time buyers is adding all the appliances.
Okay.
Because then it's a cost. Adding all the appliances, because it's a cost that they no longer have to buy the fridge or the washer and dryer.
For sure. Yeah, I've definitely seen that, especially a lot in new construction, where generally, there's a lot of added expenses like blinds or something after the fact versus an existing home. So appliances is definitely a great one. Peter, what are some ways that you've seen, employed in helping make a transaction be a win-win through concessions?
Other than a monetary concession?
Yeah, other than just like a flat out, closing costs.
I think sometimes timing the transaction, so closing near the end of the month so that the kind of the cash to close for that buyer's a little less.
Yep.
I think that's valuable. I think offering some kind of seller financing. I actually have a property right now where it's a big enough sticker price that with a solid down, my guy would do seller financing.
Sure.
So, I mean, that's a type of concession on the terms of the loan.
Yep.
So,
Yep. I appreciate that.
Lease back.
Yep. So I know, I saw, and I'm sure you guys saw a lot of, it wasn't even price, it was terms that were important to clients. And a lot of times that was because they may be building a house and their home's not going to be done, but they want to get the home on the market so that they know that they're going to have cash to close. And so I definitely saw lease backs being one of the, major terms through the last probably year of sales. So yeah, so terms can definitely be a win-win and useful tool without having to reduce price. Who else we got? Cameron, you got any ideas on tricks and tips that you've seen over the years? You've seen a lot of contracts from the Red Sign team.
Yeah, one of the craziest things. Cam. I was like looking for it. Where's Cam?
I've seen the sellers write the offer and leave it in a house with all of the terms spelled out. So purchase price, what they'll do for down payments, everything, all the buyers need to do is sign. I thought that was the craziest way to structure an offer, is from the seller side rather than the buyer side.
Making the transaction super simple for the did you say it was for the seller to sign? Oh, for the buyer to sign. Okay. Yeah, that's definitely a unique one that I've never seen employed before. Anybody else? I saw Becca. Did you raise your hand again? All right.
One that will be helpful for our sellers, because I'm assuming this is it's hard to sell your house scenario, not everyone can sell, is the assumable loan, because all of our FHA buyers who have really low rates right now, if the buyer can get a second primary loan, they can assume the first and then have at least half their payment lower.
Yeah, so definitely a creative way of financing. I'm just gonna share the thoughts that I had. So like Peter said, we could just do a straight closing cost credit. I was kind of trying to think more outside the box. And I wouldn't say this is related to first-time buyers or even people that are, necessarily cash strapped. It's just a way to incentivize the buyer to maybe make them feel a little bit more comfortable with the transaction. So I know there's extended home warranties that are offered. So through your different vendors, you could look at the options for extended home warranties. So I know in new construction, there's like a 210 home warranty. There's warranties that can go out 5 years. So it just gives the buyer that added sense of comfort that, hey, I know you had to spend all of your life savings and probably borrow money from your family to get into this house, but the seller is going to provide an extended home warranty. So hopefully, with that warranty, there shouldn't be any unexpected costs that you're going to need to cover in the near future.
I took that a step further. We had a listing where the house was 1940 something. Everything is at the end of its life,
Mhm.
knowing full well that the buyer is going to want what? Some kind of credit.
Yeah.
So I double checked, found out what the price of an extended warranty for 5 years on all of this would cost. It was approximately 2,500. Seller for 2,500 will take this off the table. It's non-negotiable. Why are you worrying about end of life? You have 5 years versus knowing that they're going to want 10 here, they want this here, and proactively saying you have a 5-year bumper to bumper warranty with all of these things. And it was easy to absorb
Yeah.
versus having to negotiate it on the back end.
Yeah, and sometimes, especially, let's say for instance, you have a house that might be older, you could offer that just on the front end in the listing to entice buyers and let them know as they're going through the home. That the seller doesn't have the flexibility to replace the furnace, air conditioner, all these things, but that the seller's going to provide a warranty to give that buyer some additional comfort. So I like that one. Like along the lines of what Becca was saying, things that I've seen from the new construction side is finishing landscaping. I mean, nowadays on even probably a starter home, you're going to spend $25,000 in landscaping. And so it's just an added expense after closing that, essentially makes it that much harder for a buyer to jump when they start adding up all of the things between down payment and closing costs and moving expenses. Now they need to buy blinds and appliances, and it all adds up pretty quickly. And so that's one way that I've seen that can definitely entice people to purchase. Not so much applicable on existing homes, but something I've seen used a bit in new construction. Also, like Becca was saying, the appliances. I've seen a lot in new construction and basement finishing, where the buyer's like, hey, I qualify for more and I have the down payment to cover an additional 5% on a $75,000 basement finish, but I would really like to roll in the cost of that basement finish so that I don't have to come up with $75,000 out of pocket, deal with subcontractors after closing. And so that can be a win-win, where generally speaking, if a builder's still under construction on the house, he can get subs in and take care of the basement during construction. So the other is repairs. For example, there might be deferred maintenance, like carpet might need to be replaced, repairing furnace, roof, air conditioner. There's all sorts of deferred maintenance items that may be an added expense. I was just doing a transaction right now where the home inspection report came in, and they said, there's probably $7,500 of deferred repairs that need to be done on the house. And for my seller, that's pretty difficult to do because they live out of state and they're single. And so we negotiated for those repair items in this specific instance to just come as a concession. We're going to give them a credit towards closing costs. So it was a win for my seller because they didn't have to take care of the repair items that would have been difficult for them to schedule and probably delay closing. And then it was a win for the buyer because they can go out and pick out their carpet or whatever after closing that needs to be taken care of. So overarching, what we're trying to look for is a win-win in this situation. The market is not a seller's market right now. It's not a buyer's market right now. It's a more normal market. And so I would say as we're negotiating transactions, we're looking for something that's more balanced. We're not trying to get the seller to cover every inspection item, but we're also not expecting the buyer to, hey, waive inspections and don't worry about anything that's going wrong with the house at this point. So it's getting back to a more normalized market. The second option for sellers in a shifting market is seller funded permanent buy downs. So does anyone want to explain what a seller funded permanent buy down is? Riley?
So one is a 2-1 buy down, correct?
A 2-1 buy down is that's going to be a temporary buy down. So
Okay.
that would be for
In that
For
case, I'm
2
going
years.
to delegate this to somebody else.
So permanent buy down is going to be something that's less impactful, meaning a 2-1 buy down, buying the rate down 2%, then 1%. Same dollars might buy the rate of the loan down the full 30-year term, maybe a half a point or 3/8 or something, but it would be for the duration of the entire loan instead of just a shortened period.
Yeah. So let's say this person is thanks Brad for explaining that. And Riley, I'm not picking on you next time. You're good. You can explain the 2-1 buy down. That's on here as well. So like Brad said, it's not as impactful as far as the payment reduction, but for somebody that's not a first time buyer, let's say this is a long-term home for them. One of the benefits of a permanent buy down is you can look at this and say, listen, you're not going to be here for the next 3 years. You're probably going to be here for the next 15 or 20 years. Let's look at your amortization schedule. And man, over that 15 or 20 years with that permanent buy down, you saved $20,000 in interest, $25,000 in interest. And then it becomes a little more palatable for people to buy in a peaked market or in a market where rates are higher. So a permanent buy down can be a good option. One that's not on here that I also just thought of is I'm not sure if you guys have ever had lender paid MI or had MI paid off. Have you guys ever done that? Because it can be a pretty good option to say you have a transaction where the mortgage insurance is $150 a month. That $150 a month can be the difference of the buyer qualifying or not, because they might be tight on debt to income. And so if you can get rid of the MI, that can reduce the payment, and it's a much smaller cost on the front end than a rate buy down. So Becca.
So you reminded me of a conversation I was having with the lender yesterday. So instead of putting 20% down, we talked about putting 15% down and then buying out the MI for that extra 5. And it saved my client $75,000 in their down payment because high price point.
Yeah.
Was it 75? Anyways, but that's a way to get your buyer more money without changing their payment a ton.
Yep, that's awesome. One thing that I found to be really beneficial is trying to get my clients to open up about their financial situation so I can understand it a little bit better. And if they're comfortable in doing that, generally speaking, I'm able to help them and the lender come up with a structure that's actually works really well for them. A good example of that is I've had clients that maybe they owe $15,000 on their car. They've paid the majority of the car off, but their car payment's still $500 or $600 a month, right? So rather than taking that $15,000 and putting it down as additional down payment on the home, which is not going to make pretty much any dent in their payment, I'd suggest say, why don't you go talk to your lender and find out, hey, what would it look like if I were to take that $15,000, retain it, and instead of paying it down towards something that's a 30-year AM that's not going to make much difference, I'm going to take that same money and I'm going to put it down towards paying off my car, and now it's a secured debt that's tax deductible in an appreciating asset versus a depreciating asset. So just looking at the money and the big picture and saying, what can we do to structure this to be a win? And I've also found it to actually allow buyers to qualify higher. So when somebody might be on the bubble as far as qualifying, paying off some of these smaller debts have really bumped their qualification up quite a bit. So, Peter.
So it's been a number of years since I've done this, but I've actually had the seller pay off a debt for the buyer at closing because of the bump it would give them on their DTI.
We said we're going to talk about legal ways.
Yeah. Well, and the lender had to approve it, so, And the reason we did that is because the seller couldn't give them any down payment. This was post, those Nehemiah programs that were existed with. It was after that had ended to improve their DTI, that like a small balance on a car loan.
Yeah, I've actually seen, and I don't know the details of it because I didn't dive into it, but I saw somebody's student loans get paid off through their home purchase. It was pretty interesting. Will?
Yeah, just a couple quick comments on this, on that paying down debt at closing. The path of least resistance is to let the client know they can actually pay it off at closing based on what the balance is on the credit report. It just decreases paperwork. So if they have a $15,000 balance on the car and they're
Yeah,
going to
they're
put
just
us
bringing it
down,
to the title company.
they're just bringing
rather
it to
than all of
title.
their
Exactly.
debt.
So you can speed up a loan process by a couple of weeks doing it that way. The second thing is, and maybe you're going to get to this, but interested party contribution limits. So if you have 10% or more down, Fannie Mae allows up to 6%. So if you have less than 10%, it's 3%. So in terms of a permanent buy down, that could be pretty awesome if
Yeah.
someone's, considering, oh, I'm going to put 7 or 8% down, but I don't want to make this offer motivated. Maybe you could get them to 10% and have a really big seller credit.
Yeah, I appreciate that. What, can you let everybody know what lending company you're with?
Oh, sorry. Yeah. Revere Home Loans,
Awesome.
brand new broker. So.
Yeah. Perfect. Well, I appreciate you sharing that. That's not on my slides. It's on the student manual paperwork that I can send you guys, but very applicable because it's important to understand you don't want to structure a transaction that has too high of a percentage of seller contribution and find out, hey, right before closing, this actually isn't going to work. When might this be effective for closing costs? Credit, I was just saying when it's too common. Like in the past, the market was, everybody was asking for closing costs. They're trying to get in with 0 down payment, seller paid closing costs. And that's what, led to a lot of the foreclosures last time. This time around, I would say people are less motivated by closing costs because it's, one-time $5,000 or $7,500 contribution. They're more, I would say, more affected by rate reduction, rate buy downs, long-term buy downs, or the concessions like we talked about. Also effective when interest rates are higher than average and prices are high. The seller-funded permanent buy down, it's just a creative way to highlight how much money a buyer can save. Going back to if you're looking at an amortization schedule, hey, I know you're paying, a lot for this house, but long term with this rate buy down, you're actually going to save $20,000 in interest. Another challenge is seller funded temporary buy downs. So Riley.
So a 2-1 buy down is where a seller prepays, large portion of, I don't know how much money it is specifically, depends on the loan program and everything, but basically it lowers the interest rate 2% the first year and then 1% the second year, and then returns to the base rate of whatever market rate was on the third year. So that summarize?
Yep.
What it was. So if it's a 5% rate today and you do a 2-1 buy down, that means the first year the rate's 3%, second year it's 4%, and then on the third year it goes back to 5.
Yeah.
Sorry, I don't want to be smart, but so basically the rate actually stays, it's 5%. There's just money that goes into an escrow account that pays the difference between a 5% payment and a 3% payment. It costs about 2.25%. If you want to do a 2-1 buy down, it has to be paid by the seller. It can't be like a gift from mom and dad, something else. It has to be paid by the seller. And the great thing about a 2-1 buy down is that if they refinance in the next 2 years, basically there's this escrow account there, and that money actually gets applied back toward their principal balance and reduces their principal balance. So the money never, like if you do a permanent buy down and you refinance in 6 months or a year or 2 years, that money's gone. It's basically you just paid more for your house than you needed to.
Yep.
If you do a 2-1 buy down and refinance in 6 months, you get that money back. So as a mom and a grandma, that's what I would tell you to my kids to do. It's a 2-1 buy down, not the permanent buy down, just because there's a high likelihood the rates are always going up and down and we're always refinancing. So instead of just losing that money that the seller paid for you, you can get back.
Yep.
With the buyer, they qualify against the whole thing, right?
So that's the problem is, yes.
So the buy down may help their pocketbook, but they still have to qualify for the big net.
Yeah, 5%.
Which is good. Yeah, for sure. So making sure that the buyer understands and feels comfortable with the reality of what the payment's going to be year 3 is probably the important thing on explaining that as an option to your client.
So Sherry just asked me 2.25% of what, and it depends, but pretty much 2.25 of the purchase price. So of your 3% that the seller could pay toward concessions, it'll cost about 2.25% to do that 2-1 buy down.
Okay.
I think obviously, right, your client has to be prepared to be paying that higher interest rate,
Yep.
the top interest rate. But obviously, if rates go down, excellent, we can refinance. And if they go up, well, good riddance, we got you at the 5% that you were at.
For sure. And I would say you're probably going to see a shift in this moving forward just because I think people are going to be staying in their homes longer. But in the past, I've seen clients staying in their homes 3 to 5 years. Investors are buying properties, letting it appreciate, moving their money quicker in the past than they have because they want to sell it before there's deferred maintenance. They're just trying to get in, get that bump, and then move on to the next property. And so if you can get the rate down for that first couple of years that they're going to buy it, they may never refinance. They may sell the property before they even really get to that higher payment. But you'd want them to make sure they're comfortable with the higher payment in the event that they keep it longer. But who knows how long they're actually going to ultimately end up paying that higher rate. So it's a great option for people that are like, hey, I'm here for school. I know I'm going to be here for this period of time, and I'm going to do a 2-1 buy down. Worst case scenario, if I end up staying longer, great, I can afford that payment. But chances are I'm just going to be here for my grad school program, and then I'm moved on. And it's a way for them to get that payment lower. So correct me if I'm wrong, one of the lenders here, but was talking to a lender recently. They said the 2-1 buy down is not an option for investors. It has to be an owner occupied property. Is that correct? Will? Yeah. So just something to think about if you're working with investors. You may want to double check that the seller, I don't think the seller can do a 2-1 buy down on investment properties. I think it needs to be owner occupied. So just before you get a deal structured that way, I think that will especially become critical when you're seeing, big builders like Edge Homes offering marketing these really low rates, and you get an investor buyer under contract and now surprised they actually can't buy that rate down for your buyer. So just food for thought.
2-1 buy downs for years and years. It's just come back that, okay, and nobody wants to pay these high prices. They're having sticker shock. I just did a loan for kids that were $1,200 payment, and now their payments $2,500, $2,900 with their almost $2,900 with their HOA, and it's like sticker shock. These guys are, so it's just a way to go, okay, for the next 2 years, your income's going to keep going up. Your payment's going to be low. When it goes up, you're going to be able to afford it, kind of thing. Nobody wants to afford a 50% debt ratio. It's just not, we can qualify them for that, but that's not, nobody can afford that, really. So mortgage insurance, no. So mortgage insurance, FHA mortgage insurance, 0.85, it's across the board on it. It doesn't change. Can't buy it out. Life of the loan. The rates on FHA, on Utah Housing are just, and when you look at their website, that's what it is. It is what it is. There's no way to buy them. They can, you can pay their
$5 million you can pay cash for the house. No, there is no interest rate.
You could have the seller still pay closing costs on a Utah Housing loan, but you're getting that's the beauty of a Utah Housing loan, is that the Utah Housing is giving you the second mortgage for the closing costs, so you don't have to do that. Does that make sense? if you had sellers that were willing to do it, then just do a regular FHA loan. Don't do the second.
Yep. So we're on slide 3 of 16. So I'm going to breeze through some of these a little bit. But I think the ones that we've talked most about are probably most applicable right now in this market, which are buy downs and concessions. So if there's any takeaway from this, I think these are the most applicable items in the class. So like Peter talked about, there's another option of owner financing. Has anybody ever done owner finance deal? This would be seller owns the home free and clear and the market's not good, or maybe the interest rates are high and seller's like, hey, I'm motivated for a 5.5% interest rate with a balloon. I will finance, I'll seller finance this property. Adam, did you raise your hand? Okay. You want to tell us a little bit about the structure of how you work that?
It was a tough sale on a piece of land. The buyer was pretty persistent and the seller didn't want to do it. So the buyer started stalking the seller and talked him into it.
And were you the buyer?
I was not. I wish I was, because it doubled in value almost in 2 years. So it's a cool option for the seller because they get an option to kick the buyer out pretty much at any point during the transaction because they're the underwriter. So
you guys got to come up with terms.
Seller's got to ultimately agree to them at a certain point, or
generally speaking, it's still going to require down payment. It's just a different form of a loan. The seller's the one that's still holding the notes rather than the lender. And so
there's a pay service that handles the payment. They charge a very small fee every month, and there is also an automatic foreclosure clause that you can put into a contract like that. So if they miss even one payment, it automatically reverts it back to the owner, the original owner. So there's some quirks about owner financing that are pretty good.
If you're going to do this, I would probably have your buyer consult an attorney, just because definitely more complicated than, and a lot more pitfalls than a normal transaction. So, or if you're representing the seller, have your seller talk to an attorney. Thanks for explaining that. Similar to the seller financing, there's lease option. I've done this before. Wouldn't be something I'd probably advise a lot of clients. It's complicated because typically when there's an option deposit, I'll get you in a sec. When there's an option deposit, it's a listed property. Listing agent wants to get paid. Buyer's agent wants to get paid. Seller wants security. So they still have to come up with a pretty good amount of money to be able to go into this lease option, or listing agents not getting paid until they exercise their option. Buyer's agents not getting paid. So they can get pretty complicated to explain to the seller, hey, I know I actually didn't technically sell your house, but I want to get paid a commission. So, I brought a buyer and you guys agreed upon these terms. So there's the lease option. The nice thing is for a buyer is if they enter into a lease option, they're securing a future price. So they put down a option deposit, and in an appreciating market, they're taking advantage through that lease of the appreciating market. A lot of times sellers are smart and they're saying, hey, if you're going to do a lease option, I'm not actually buying it for 3 years. I'm actually going to sell you at a future price, essentially. So this is my sales price today. You're not buying it for 3 years. The sales price goes up $20,000. So Becca, you had a comment on lease option.
Actually, it's on seller financing. So one thing I learned recently is if your seller does a seller financing, they can't count that income until a year after, and it shows up on taxes. So they still have that debt payment if they did a seller financing wrap. I think it's a technical name. So, but lease option, it does count just like a rent. So if they're in a spot where they have to buy a new property, they might be money ahead to do lease option.
So
or
so
finance.
you're saying when you're trying to offset debt for debt to income and the seller wants to purchase another property.
Yep.
Anybody else have any comments on the lease option? If not, we'll move on. All right. What can buyers do in a changing market? I would say probably more applicable in the last 18 months of market, less applicable right now, but we're going to go through it and just kind of talk through it. So using a 401k, so a buyer doesn't have enough in savings for a down payment. FHA and zero down loans still require closing costs. So has anybody ever had a buyer borrow from their 401k to use as down payment? Sean? Tell us how that transaction went and maybe positives and negatives.
Unfortunately, this transaction actually ended up failing. It didn't go very well. No, this was, we were competing against a lot of people with really aggressive earnest money. And so we ended up needing to have the contract written in a way where we were able to put up their earnest money, but then also come up with a larger down payment to be competitive. The main drawback to it is that you have to pay back the 401k pretty quickly because it's a loan against yourself.
Yeah.
And ultimately the buyer ended up not feeling comfortable, which is why we didn't end up with a final transaction.
Yeah. So it's essentially, it's not a long-term solution. It's basically a bridge loan. You know, there's various forms of coming up with cash. The 401k loan is just one way to, like you're saying, it can be pretty quick. Like, so when we saw, 3 days. All right. So when we saw a lot of cash buyers in the market over the last 6 to 12 months, and let's say you're working with a buyer and they've sold their home, but they don't have enough money to, or they're selling their house, they don't have access to all the cash. This is a creative way to borrow against that 401k to come up with down payment towards either higher earnest money or higher down payment to make the deal work. So
That's gonna be paid back in 60 days. At least the last one I did had to be paid back in 60 days. So they basically gave themselves a $300,000 bridge loan so
Yeah.
they could qualify for the new house and the old house at the same time. And we don't have to count that against them. They basically withdrew $300,000 and we don't care. It's not like a loan on a 401k. You don't have to count it against you. If you took a loan, they just withdrew it and made it so they could buy this $1 million house and then sold their house, paid it back within 60 days.
Yep.
It was brilliant.
so it doesn't count in your debt to income because there's no payment.
Is
Right.
there interest during that 60 days?
No, because they took a withdrawal and there's no tax consequence if you put it back within 60 days.
Yeah, it's your money.
But if you don't sell your house, then you're up free.
Yeah.
You're paying.
Yeah. So there would be large penalties. So you need to be fairly confident that, hey, I'm going to be able to pay this back within the time period
They wanted
before
the house
penalties.
So bad. They were selling 2 other houses.
Yep. I have done that, had my client liquidate his 401k because he was selling his home and couldn't come up with the cash. It worked fine. We didn't get our money within 3 days was the biggest issue, is it had to go through, a lot more process to get the money. And so it was complicated.
So I've had that same thing where we couldn't get it within 3 days. So what we did is we did smaller earnest money and then on section additional earnest money. I don't remember what no. That's where we put that we'd put more money down. And that's the only time I've used that section.
Perfect. Yep. And you didn't have to pay more for the house. You just came up with a creative term to be able to make it work for your client. So I like that. The other is similar. It's just a temporary IRA transfer. So if you have an individual retirement account, similar to borrowing against the 401k, you can borrow against your IRA. Not really too much to say on that. It's a pretty similar structure. Again, I would look into the penalties if the buyer isn't able to pay that off within the specified period of time, because they can be pretty steep. Equity transfer or bridge loans, I would say that this is, has become more common. I saw a lot in new construction where the buyer would want to build. They don't have the down payment. They don't want to sell their house. And so they will go out and get a HELOC. So we'd go under contract with, like Becca said, a lower amount of earnest money. It would give them time to go get a HELOC on their house. And then they would come up with an additional amount of earnest money prior to the home starting. So home equity is a great way to come up with down payment. It's very easy to source. It's very clean. And so I've seen that used a lot for new construction. Seen it used some in with buyers where they'll tap into their home equity. So they have the money sitting before they go out and make an offer on the house. That's going to be the cleanest way to do it. Is the money's accessible, the appraisal's done, it's ready to go. You're not starting the process once you find a house, because that can get complicated pretty quick. So anybody had buyers use home equity loans to purchase properties? Come on, you guys have not had a buyer use a home equity loan to purchase a property, Brad?
For investment properties, right? If someone wants to buy a townhome or a condo or something, a lot high percentage of people are probably pulling home equity loan for the down payment.
Yep. So, yep.
If you're pulling your home equity loan, how do you make that cash flow? Like, I've never figured it out. Dumb question, but.
They may only be pulling a home equity
Yeah.
loan for the down
So I
payment
lit-
on the loan. But yes, I agree. It's
You have to be in it for the appreciation.
So I would say, so I did this for a condo in Lehigh, and it really depends on the market as well. I bought that one in 2019, used a HELOC from a townhome, a different property, investment property. And that was 230 is what we bought the condo for through Edge. Now, obviously it's appreciated quite a bit, but our cash flow obviously has grown as well. So we're at like $600 in cash flow now, but we weren't at that when we first bought the property.
bank on appreciation,
Yep.
which is not always to your point.
So we
can
were
work and
negative
appreciate-
$75 a month when we first started that property, but we were okay with that knowing our long-term play. And so we were going to hold the property for 10 years anyways. And so it made sense for us.
There's also, tax advantage stuff that you might be negative cash flowing $75 a month, but with depreciation and mortgage interest write-off, you may be still positive in the long term. So I agree. HELOCs, I'm not advising you to do this. And I agree, it's hard to get properties to cash flow, but it is a creative way, and it might only be a temporary way. Like I am working on a transaction right now where the person has a couple $100,000 in business transactions that are going to pay them in the next few months. And so they're going to take a HELOC on their house, knowing that, hey, in a few months, I'm going to be able to pay that HELOC back, or I'm going to sell the house and pay it off. Peter?
One other advantage of using the HELOC is that when you do pay down that principal, the payment drops. So that doesn't happen with a regular 30-year fixed mortgage. That payment stays the same. So if you can put more on the HELOC and, pay down more on that principal in the future, maybe a tax refund, whatever whatever source. So if it's a temporary strategy, I think it's a really good temporary strategy, because the cash flow can shift pretty quickly when you pay down that principal.
Never mind.
Thanks.
So with that though, if they have a HELOC open, but they haven't used it yet, that still counts against their DTI, right? So that in some situations that actually may harm them, if I'm understanding that correctly.
Yeah, qualify. If you're tied on qualifying, it's gonna, we actually have to get a copy of the note and figure out what the new payment's gonna be. You can't use the zero that it's been for 20 years, but yeah.
So there's also two different things that we're talking about. There's a HELOC, which is the line of credit, which is essentially like using your house like a credit card. It can be, you can draw on the line of credit, you can pay it down. A home equity loan is an actual loan. And so you're not drawing on that the same way you would with a home equity line of credit. The the times that I've seen them used, they're typically amortized over a shorter period of time, and it's higher interest. You might be amortized over 10 or 15 years. So I wouldn't say it's always a great, long-term solution, but
Usually they start out 10 years of interest only payments, and then they lock it after 10 years, and it's 20 more years of payments. So you can't use it anymore after the first 10 years.
okay. Thanks for clarifying that. So to Brad's point, and why you're asking why would somebody buy with a HELOC? Sometimes people have a lot better opportunities than the 5% or 6% they're paying on a HELOC. They might be making 18% in the stock market at the time, or another business venture. And so they're like, I'd gladly pay 6% on a HELOC on my house that's tax deductible and not take the money out of the stock market and pay taxes on it for down payment. So just kind of understanding everybody's motivations and why they might want to do something's helpful. Or they just might find the perfect house and they're like, I don't care about the cash flow. I've been waiting for this dream home my whole life. So it's just a bridge loan or an equity transfer is just, can go be a creative way to make a transaction work. Yes.
Your HELOC rates are going up. Your payments going up.
Yeah. So temporary solution. Down payment.
On that as well. It's like, yeah, no, isn't it different for each one? I thought.
I would just
That's
make
credit
sure
card
if you're
level. Never
gonna utilize a HELOC, make sure you understand the terms. Down payment sources and gift funds. If you've been in the business long enough and you're around BYU, we call them kitty condos. So it might be a parent co-signing for a child, a newlywed or student that needs to get into a condo. So rather than them paying for their kids' rent, they're getting, friends and things into the condo. They are a non-occupying co-borrower, or they're gifting down payment funds and, to help family financially get into properties. So there are creative ways to either get co-signers or get, gifted funds for down payment that can be utilized. I would say that was very prevalent in the last 12 months. I was like, man, how are all these young people coming up with cash to purchase a house? Well, it's because their parents are pulling out a HELOC and helping them buy the house cash and then taking out a loan after the fact. So, like I talked about, non-occupying co-borrowers. So that's something to understand. Like not all loans allow non-occupying co-borrowers. So I don't know if you understand what that means, but basically what that means is if the co-signer is not living in the property, not all loans would allow a co-signer that's not living in the property. So I know FHA, I assume it's still the case, would allow a non-occupying co-borrower, but a lot of conventional loan products would not allow a non-occupying co-borrower. So just understanding what loan product you're putting them in. I wouldn't suggest, hey, go get your dad to co-sign if you're getting a conventional loan that doesn't allow a non-occupying co-borrower, because eventually you're going to find out that deal's going to fall apart. What lenders can do in a changing market. Since we have a couple lenders in the room, I'm sure we'll have you guys help us with this, but challenges: market's tight, inventory's low, homes are selling quickly, and the buyer won't be fully vested in his pay structure for 2 years. So what that means is, let's say somebody went and took a job at Podium, they're getting a base salary of $60,000 and they're getting commission for the other 20% of their income, whatever it might be. They can't count that commission income until it's averaged typically over a 2-year period. And so there's ways to have lender funded buy downs. I don't know how applicable that would be right now, or rates are so dang high. Will, do you want to talk about, are you doing any lender funded buy downs currently, where you're bumping rate or anything like that?
Typically not, because the market is leery of early payoffs. And so they're not giving as much credit back the higher you go up the rate sheet. So you're seeing incrementally, normally going up 1/8% would give another 0.5% credit towards closing costs. But right now it's more like 1/4 to 0.3%. It's pretty low.
Yeah.
So that pushes you up almost high 5s, low 6s when, mid 5s is kind of the equilibrium rate.
Okay, thanks for
So-
explaining that. So in the last downturn, sellers would pay whatever to get their home sold. So they were paying closing costs. And then it went to a more of a normal and then buyer's market. And so the tactics changed. It's like, oh, I can no longer get the seller to contribute towards closing costs. Rate's low enough, I can qualify. I'm going to have the lender bump the rate and credit me back to pay towards closing costs. Now, with rates as high as they are, probably not seeing a lot of that. That tactic shifting more into buyers have to have their own down payment, or if they have to get creative with gift funds. My mortgage community, this is more of just another tactic of people trying to get in with zero down products, like you were saying on Utah housing. So there's loan products, they're niche products. There's not a lot of lenders out there that are offering zero down payment loans, but there are specific loan products, and a lot of times I've seen them geared towards first-time home buyers. Maybe you go to UCCU and they have a first-time home buyer zero down payment product. The downside to those is a lot of times those interest rates are higher. So yes, they're getting in with lower down payment or no down payment, but their rate's higher. And so ultimately so the lender's taking a risk and they're not going to take that risk without some reward. And so generally speaking, if the buyer can come up with gift funds or some down payment, it's going to be a lot better loan option for them.
Upfront mortgage insurance and then the closing costs have been added to your second mortgage, you can walk out of there owing $20,000 more than you just bought the house.
Yeah, so I saw that in a lot of instances in the last market shift where you had it was pretty normal for buyers to get in with a first and second loan or a zero down loan product. And the instant that they close on that property, they're going to be underwater because their closing costs, there was additional fees added to it. And then to go and sell the property, they're going to pay real estate commission. And, it's very tough to put people into zero down loan products and feel good about it, because I know that chances are if they have to sell that home in the next 2 to 3 years, they're going to be underwater. Yeah. Yeah, if you're banking on appreciation and it's a great market, yeah, maybe it's a niche loan product that could work for some people. To Shoni's point, like, hey, I wasn't banking on cash flow, I was banking on appreciation, and it's the forecast is the market's going to appreciate. Maybe it's a good option. Adjusting amortization periods. So this is something that I know I talked about with Peter, Brad and I have talked about. We're like, man, how in the world are people going to afford houses? We're talking about this 12, 18 months ago. And so one of the things that we thought we would foresee in the future was longer AM loans. And so eventually the market cracked enough that you started to see a few lenders like MacU's come out with I think a 40-year loan term. I think countries in Europe and other places have even longer 50-year loans and stuff. It's just not normal here in the US, but that is something that I think you will probably see becoming more normal over the foreseeable future, because rates have to be at 5.5% historically to be healthy. And I don't see labor costs coming down. I've never in my life, as wages gone up, seen wages drastically drop back down. And so the only thing that I foresee that's going to help with the affordability issue is more niche loan products. I mean, you've seen it in the auto industry. The loan type used to be a 5-year loan, then it went to a 6-year loan, then it went to a 7-year loan, just because people aren't focused on, they're not focused on paying that loan off. They're focused on, what is my payment here and now? I need to have a roof over my head. So if you have clients that are in that situation and they're like, man, I just can't rent's too high, maybe go talk to one of these lenders, go talk to MacU and find out, are there loan products that are amortized over a longer period of time that might get my payment down so I can get into a house. So has anybody used any of these longer term loan products at all? Like the 40-year AM? I was talking to someone in the office about it, but they said that, yeah, it's a longer term, but it really doesn't benefit a ton because the rate's higher. And so ultimately it's just not a whole lot of benefit. So, all right, we'll move on. Adjusting interest rates, cover closing costs. We talked about that. So we'll skip this. I don't think we're going to see a lot of adjusting interest rates to cover closing costs with how high rates are right now. And then something that, trying to think, who did you bring it up? The Nehemiah gift funds and things. Somebody brought it up, but in the past, and I haven't seen it a lot right now, there's government grants for college. You don't have to pay for college anymore. I'm just kidding. Now, government grants for like down payment assistance. So there's been all sorts of stuff. There's been new construction grants. There's been like specifically in Provo, if you're buying within a certain block within Provo, they would give you a grant to be able to buy. There's all sorts of different terms, whether those have to be repaid or not. But if you have a buyer that, generally speaking, it's for low income, and so there's not a lot of buyers that would qualify for this, but you may want to talk to your lender about grant programs as well. That's an option for buyers.
Their income has to be so low that they can't qualify for the house anymore.
Yeah. Yeah. Yeah, somebody's making so little money that they can't qualify for the house, but in reality, they couldn't afford to make the payment anyway. So it's kind of a, hey, we offer this grant program, but not a lot of people use it. Yeah, that's counterproductive.
So she ended up starting a new job after they closed, but she had to quit her job for a few months.
Yeah.
So,
we call that creative financing.
yes.
Yes. So the last option, which I have never put a buyer in this, but I'm just sharing the content, is private lending. A lot of times that would mean hard money or maybe borrowing money from a family member. So private lending tends to be high interest, much higher risk. Not really something I would probably suggest, but is an alternative option for maybe somebody that can't get a traditional loan for one reason or another. They have good income, they have good down payment, but maybe I had a client that his dad took out a bunch of student loans in his name, ran up 6 figures in student loans and destroyed his credit. Kid's super responsible, wants to buy a house, but his credit's trashed. And in that scenario, it's like, this might have been a good option for him. Not something I'm going to suggest, but there are sometimes options for private money if you know it's a short-term, scenario. So bottom line is, really just wanted to focus on, there are opportunities. There's always opportunities no matter what the market is. So rather than going and sitting in our offices going, oh my gosh, interest rates are crazy. I can't sell the house, market sucks. Look for opportunity in every scenario. It might be an opportunity for a seller. It might be an opportunity for a buyer. Hopefully, it's a win-win, but Brad and I are always constantly talking about, what can we do to find opportunity even within a shifted market, right? So if the market's down and we're selling something for less money, well, that means, hey, let's go find a bigger property. We can hopefully take advantage of, a discount on a bigger property. So that's my takeaway from this class, is there's always going to be opportunities. Consult with your team. I've always been told my network is my net worth. And so something I found a lot of success in is staying close in touch with my network, meaning I'm staying in touch with my lender. What are you seeing in the market? I'm staying in touch with my title company. I'm staying in touch with, you guys as agents. And so I would just encourage you guys to consult your team, look for creative solutions, and the definition of insanity is, you know, trying the same thing over and over again and expecting a different result. These are different times in the market. And so what you've done in the past to have success in transactions, it may not work at this point. And so I think it's really important that, you know, we spend time talking to each other about the challenges that we're facing and what we can do to help each other come up with creative solutions to keep these deals together, bulletproof them, help our clients. So how much time do we have left? What time is it? Okay, sorry about that. All right, well, then we won't do any kind of breakout session. I appreciate all you guys participating. We have some food in the back. So thanks for coming, and hopefully this makes you some money keeping some deals together.
Awesome. Thanks, Joel, so much. We will send out all of these slides. So that will come in an email. If you don't receive it, shoot us a message and we'll get that over to you. Next week, the conversation will be around buyers, creating urgency with buyers. And this is such an important factor. A lot of that will also translate to listings and clients on that side of the boat. But obviously with clients having tons of options with inventory now, you have to successfully navigate them to make a decision. And that's what we're going to be talking about. So we'll see you next week at 11 a.m. Thank you all.